Hello there, folks, and welcome to another episode of the SwingTrader Status Update, the weekly status update. I'm Justin Nielsen, your host, and back from a little sojourn is Mike Webster, our chief, what is it? Director of Market Strategy.
I'm a random dude.
Random dude we picked up off the streets and all that. So, Mike, you were out last week. You missed some activity. I feel like
what happened, man?
I feel like you took your eye off the ball, and you really were needed to keep the market in line. So we'll talk a little bit about the expectation breaker that we had, and really this seems like it's turning into the market of expectation breakers being kind of our signals. We'll talk about how we handled it afterwards, and then also what areas we're looking at. It seems like there's this, is it a rotation? Is it not a rotation? So we'll kind of answer that question, but let's start with the market, if you don't mind, Mike, and kind of get your thoughts. You want to start with the NASDAQ?
Yeah, why not?
Mm-hmm. Okay.
So, you know what? In fact, let's go with the S&P because I want to focus on that the most today.
You took one look at the NASDAQ and you said, you know what? No, I don't like it.
That's too ugly. Well, the main point that I wanted to kind of drive home today is the level. If you could do a line pan at the August 1st high, because I think that is kind of, we were talking before the show, is I look at, when I see this chart, that's pretty much all I see, is I see that we're underneath that. And that is a very important line, in my opinion, because that was the middle of this oddly shaped double bottom that we had for SPY. I know it's not an unusual one, but you can see your first bottom, and then you came up and hit that line on August 1st, and you came down and you hit your second bottom at the 51.19. Then we broke out and everything was acting normally. Then I went on vacation, and somehow you messed up the market.
Right.
I don't know what you and Dominic.
I'm going to say, look, we're live on YouTube. I'm looking at the comments, and I think everyone's blaming you, Webby. So
it's all my fault.
It's all your fault. That's the consensus of three so far. So
yes, okay. So, anyways, that line there that we have, that's what we broke through last Tuesday, and last Tuesday was an expectation breaker, and just we've seen more expectation breakers this year than I ever remember seeing. And earlier today, the two of us were talking about how to program in an expectation breaker, which is something that the three of us, me, you, and Charles Harris, when we were designing the market school rules and came up with the expectation breaker concept, we couldn't define it.
It was a know it when you see it.
Yes, you know it when you see it, and you see a lot of these on here. And so last Tuesday was one. The August 1st, where you have the line, that was a very big one. So let's talk about that for a second. We had the day before that, we had a follow-through day, and then we immediately failed, which is not what you want to see. After a follow-through day, you can have some back and fill, but which, just going back and forth a little bit, going sideways, but you don't want to see a major fall like that. That was a real big expectation breaker, especially the fact that it went up higher earlier in the session and then came down and it crashed through its 21-day, which is your green line there. Then, of course, we had the heavy selling for a few more days, and then the bounce up, and we had our follow-through day along the way, and we got our low above our 21-day. Our 21-day was above the 50-day for 5 days. So that Friday, that was the start of a what we call a power trend. And that's when you have your low above your 21-day for 10 or more consecutive days, and your 21-day is above your 50-day for 5 or more days. Those are the two important things with it. Now, that's not a buy signal by itself, but it does give you a clear expectation of moving higher. And it's a big part of the market school rules. And essentially what it does is, as you get more buy signals, it allows you to not take defensive action on sell signals. But like I said, it wasn't a buy signal. So we didn't really do anything differently other than turn on that power trend. Now, immediately on Tuesday, we had a gap down and your crash through your 21 day, it did hold above the 50-day on that day, but just barely above it. But that was a clear expectation breaker, meaning if you've never heard the term expectation breaker, it's when you're set up one way and then the market goes the complete opposite way in a big way. So that
And to
was
be
a great.
clear, expectation breakers, we're talking about some negative expectation breakers where it was set up to go up, and that's not what happened. But it can go the other way, where you have an expectation breaker where you would expect things to go much lower, and then boom, you get a upside reversal or something like that, that really kind of start things going in the other way.
Exactly. And these are relatively rare. Like when the three of us were searching for examples back when we created Market School back in 2011-ish, we didn't have that many. There were, there was the the poster child, which was October 31st of '07, which everyone should go back and study. And there were a handful of other ones. But now this year, we've seen a lot of them. And I think that's kind of what we're seeing in the market. The market will start going one way and then be a head fake and then just go in a completely different direction. Let's look at it on the NASDAQ.
Yeah, I was just saying that doesn't look right. I'm used to looking at it on the NASDAQ. It's very clear on the NASDAQ where this October 31st was. Yeah.
So go ahead.
No, I was just going to say it was one of those where, we had a little bit of weakness starting here. And that did get us a little defensive at the time. But then it was like, oh, we're up in new high ground. You got to be buying. This is, what are you going to do? It's all-time highs until, man, it just really fell apart very quickly.
Exactly. And before it fell apart really quickly was your expectation breaker, which was the first day off your highs. And that was a signal to get defensive. You didn't know, and you always want to be careful when you're looking at either current stocks or indexes or historical ones. You want to be intellectually honest and think with the information you would have had at the time. Do a change day back to the October 31st.
Oh yeah, good point. And this is an important thing, Mike. You say this all the time. It's important that you look at it. What did it look like on that day? Because sometimes, look, your brain is like looking for justifications, and if you see what happens afterwards, you're like, oh, it's obvious. This is what I would have done, because I wouldn't want to sit through that ugliness. But on this day, how could you help but not think that was a positive upward bias to the market?
Exactly, and that's how you would expect the next day at minimum to be an inside day. Like worst case scenario would be an inside day where it trades within the high and the low of that day, but certainly not negative. Now go forward one day, and this is something you should just etch in your brain, of what an expectation breaker is. That's what it is. Now they don't all lead to terrible bear markets like this one did, which this was one of the worst bear markets of all time. And besides 1929, obviously, and then the 2002 was in there, and the 73, 74 was a bad one. But this is one of the worst ones. And this is how it started. So it's something important to study. Now let's go to our current market, and let's do the change date. Let's go to the S&P, and let's go to the July 31st, just since we're going over this expectation breaker concept. So on this day, you have your follow through day. Your expectation, even though you close kind of off your highs there, is still to go up, or at least just maybe some back and forth, close that little gap a little bit. But let's go forward one day. And that heavy selling, like that big spread closing at, near your lows, that broke your expectations. So that high is an area that we need to get back above, in my opinion, for us to feel confident about the market. Now it went down, then of course you had you got your follow through in a few days. When was that? Like the 13th or something?
Yeah, the 13th.
Okay.
So
that's another level. The low of the 13th is another level that's very important. If we close below that, that's a big negative sign. So we don't want to see that action. But
and we already did for the NASDAQ composite, because we did have on the August 13th, we had this as our follow through day, and we did close below that on Friday. So another another negative signal. There's been a number of signals that have kind of happened on the negative side a little bit faster on the NASDAQ.
Yeah, and the Nasdaq is right now the lagging index, right? Because the S&P is our bogey. The Nasdaq, you can tell by that RS line going down how that is the laggard by definition right now. Now let's look at the New York Composite, which looks completely differently.
I'm
Zero
sorry.
NYC, zero NYC. Yeah.
Okay. Sorry, I was looking at a comment on the thing. Hi, Tim, by the way. I was looking
Hey,
at your
Tim.
comment.
So, anyways, this is your leading index right now. This is, the opposite of NASDAQ, right? It's all the stocks traded on the New York exchange, and they tend to be a little bit older for the most part, and kind of your slower, pokier names. And your NASDAQ tends to be your faster names, the ones we tend to trade. But right now, you can see this is acting normally. Like if this was the only index you were looking at, you say there's nothing wrong with the market. The market's gone up in this V-shaped pattern, went up to new highs, and then is finding support around its 21-day, which is that green line. So that's normal action. A break below the 50-day at this point would not be normal. So it holding up in this general area is a sign of a strength. And another way of looking at this one is through the RSP. It's not exactly the same thing, obviously, because RSP.
One thing I just want to point out on this one that's interesting is, this is overall an uptrend, but when you look at the relative strength line, this downtrend right here was actually occurring when NYC was going up and the New York Composite was going up. It just wasn't going up as fast as the S&P 500. So again, it kind of lets you know, okay, some of those heavy market cap weights, the Mag 7, were kind of doing a little bit more of the heavy lifting there. So yeah, it's important to remember that you can have a stock or a index going up, and you can still have the relative strength line going down if it's not going up as fast. In the same way that you can have, in this case, we've got it going down here, but the relative strength is going up because it's not going down as much. So again, that's the relative part of it, right? So
yeah, and a good illustration of that is the XLP. We'll look at that real quickly. So this is your slow pokey staples. This is a subset of the S&P 500, and you can see that that RS line just tanking there. Even though if you just looked at the price action in early August, it looked normal and natural, just going in sideways. But with everything else moving up, that's where you really need to study these RS lines and understand them. There's a reason why that was the only thing that really Bill O'Neill, the founder of IBD, put on his charts. Besides the moving averages, were just the relative strength lines. But now let's go over to the RSP that we were talking about, which is kind of the way to trade the New York Composite. It's a closer way of trading it. It's not identical, obviously, because it's slightly apples and oranges, but they tend to trade a little closer than SPY would or NASDAQ would, obviously. And so this one is a little bit slow and pokey, but you had a nice little mini upside reversal type day today, and gives you the expectation that it wants to kind of break this downtrend right here. So, which is a normal downtrend. That it's run up and it's pulled back in a natural way. So your expectation here is like, hey, this looks healthy. Now let's contrast this. Let's go back to the Qs as another way of looking at the NASDAQ. And you've got this major divergence, right? This RS line is going down. You've got this cup with handle with the handle is about as low as you would want it to go. And so you've got this major divergence. And that's one of the things that we wanted to talk about today is you're seeing a major divergence right now. What does that mean? We don't really know because the market keeps going back and forth between different sectors. As soon as the sector looks good, kind of pulls the rug out from that one, and then the sector that looked bad starts to run. And it looks like that could happen with the Qs because you're kind of in this mean reversion type of trade right now where it looks like it's a magnet for that 50-day, which is your red line. And so that's a big bounce up there. Versus if you go back to SPY, that's already back at its 50-day today. So it was able to snap back up there. So there's not as much of that kind of mean reversion bounce type of trade in this one, but this looks healthier. So that's a long way of saying it's kind of a confusing market right now. And when you're confused in the market, you want to look for things that are kind of clear. And the clear thing for me is that high from the August 1st, which is where we started this conversation. If we can get above that day and stay above it, then we're in a healthy phase. The longer we stay underneath it, I think we're kind of in a weak to neutral phase on the S&P. Obviously, the Nasdaq in the position that it's in, unless we get a mean reversion bounce, it's still in trouble. So we said a lot there, but really we're kind of waiting at this point. We're not doing much on SwingTrader last week. I think you guys did an excellent job. I was on true vacation. I was off on a cruise. I wasn't even watching IBD Live or anything. I was just trying to relax a bit.
And that's what we get,
Yeah, you guys did a really good job peeling things
back. I was saying that's what we get. I mean, no more going on cruises for you. So,
well, I think you guys did an excellent job selling heavy on Tuesday when it was hitting the fan. And why don't we, in a second,
let's take a look at the pie chart just real quick to kind of show what happened, and then I'd like to pull up the sector spider ETFs to kind of show where some of the strength is. So here's the same pie graph that we showed last week. We had certainly come off quite a bit and raised a lot of cash. So we went to 47% cash, as opposed to where we had like 0% cash before. We were like slightly on margin, maybe 102% invested, 103. So yeah, raised a lot of cash, kind of, kept some things because it was one day. We didn't want to overdo it because a lot of times you can have a snap back very quickly, but in the same way that we always say, follow through days, you want to do something, right? You want to do some buying. You want to kind of just get yourself in that frame of mind to kind of change your motion, change your direction of motion. Well, expectation breakers on the negative side kind of do the opposite. And so because of the way that last week went and everything, the last 2 days haven't changed much in that regards because Friday was so bad. But we've raised a little bit more cash, 65% cash now. We still have some retail, some autos, some consumer, and then ETF with some international exposure is down there at 2.5%. So yeah, that's where we're at. But let's talk a little bit about the sector spiders. And for as much as the Nasdaq was up over 1% at one point. It closed a little bit off its highs, but it was doing pretty good. As good as that was, of the sector spider, the 11 sector spiders, XLRE was the number one group today. Real estate. This is something that you normally think of as a little bit more defensive. A lot of these REITs are in there, and they offer dividends or distributions. So a lot of people think of this as a little bit more defensive in nature. And I mean, look at the relative strength on this, Mike. I mean, this has been looking pretty powerful.
It's been a monster. And there were many years that I would screen, and when I would, create screens for Bill and ones that I use for myself, I screened out real estate stocks, any REITs, because he didn't want to see them. I didn't want to trade them. They were too slow and pokey, but they've really changed recently. And there are a lot of them that actually look very good and kind of a nice blend of not too high octane and not too slow, kind of Goldilocks. And I think we'll look at a couple in a little bit. But yeah, you want to go where, you're seeing that relative strength. And right now it's there, but it's a bit out of there. And like what we were talking about before is as soon as a sector kind of looks perfect and hot, it tends to get hit. And then the one that wasn't, you get this constant mean reversion type of action, but we'll see if this one can trend.
XLK was the next best performer today. That's the technology sector. Looks a little bit sick like the Nasdaq. This one actually came all the way down to its 200-day moving average line. Big component in here is NVIDIA, and then also is it is it Microsoft is the other one, or is it
Yeah,
Apple?
yeah, I think so. Yeah.
Yeah, Microsoft, I believe. So I think it was Apple and Microsoft, and now Nvidia kind of took that top spot. But I can't remember exactly. So your thoughts here, Mike?
Yeah, this is basically, the same thing as the cues. When you look at it, and it feels again like it could be this bounce up to that 50-day. Then what it does at that point is different. Like how it gets there, does it do it in a convincing way or does it meander up? I would think that this just slingshots up there if we're in a healthy market, which we'll see, with tonight's news. Like we don't talk politics on IBD Live or on this show or the SMTs, but you do need to be aware of things. And obviously, with the big debate that we have tonight, the market will be looking at that, and there's completely different camps, and whoever looks like they're winning, we'll see, if the market likes that or not. So should be an interesting night for the market and to watch the futures and see how that plays out tomorrow. And what was the date of the last debate that we had? We were talking about that earlier today.
So it was June 27th. So this was the day. So of course you have to look at the next day reaction. And it was a strong start to the day. Pretty bad close, outside day closing at the lows. But a few days later and we're right back at it. So that's another thing to kind of keep in mind with some of these news related events is you can have the initial reaction, the counter reaction. Sometimes there's a counter reaction. So take it for what it's worth. I want to take a quick go ahead.
I wanted to point out on that day, because we were talking so much about the expectation breakers, is go to that day itself, just do a change date. So if people do the homework assignment of looking at expectation breakers, so with this setup, your expectation is for it to go lower. Now, the next day it goes higher. Let's take a look at that. But it went lower first. At one point during the day, it did go lower. So that's why you would look at this and say, this is normal and natural. You have a downside reversal followed by an upside reversal. Those can happen all the time. So that is not unusual. So when you're looking for those weird days, it's kind of like, well, you know what? We can do that some more on the maybe Friday's SMT or next week's. I don't want this whole thing to be about expectation breakers, but we could make it about it.
It was definitely it was advertised as the main point. So, it's definitely okay to cover it a little bit more.
Okie doke. So you had another thing you wanted to move on to?
You know what? I just wanted to address a question real quick that got from Dennis here in the YouTube comments. He was asking why the RS, or when we're looking at SPY, he was like, gosh, I would assume, I have to turn this back to current date. He said, I would assume that this would have been a 50 for the RS rating because, if you're comparing it to SPY, S&P 500, this should be right in the middle. It's important to kind of recognize that the S&P 500 is our bogey for the relative strength line, and that's why you see this flat. But the number is actually based on stocks in our database, and it's not just looking at what's going on day to day. It's kind of looking at a longer term look, 12 months, with the more weight on the most recent quarter. So it's a little bit of a different look. We're looking at everything, and so S&P 500, what you can kind of say for this is that the S&P 500 has beaten 74% of the stocks out there in terms of its performance over the last year, basically, again, more or less. So a little bit different, two different looks at relative strength. I personally like to use the relative strength line a little bit more. The relative strength rating is, I think, more useful for screening. When I'm looking for stocks to buy, I tend to go with the higher relative strength rating stocks. But when I'm doing my technical analysis, having that relative strength line there helps me a little bit more. So just wanted to kind of address that. Anything to add?
Oh, God, we could talk about that for a day.
Don't open that can of worms.
The RS number, and as you said, it double weights the most recent quarter but goes over a year, can be problematic.
Yeah.
And that's so why
It can
I
be very
developed.
slow
It
to
can be
react.
very, very. Let's look at SMCI. I haven't looked at that one for a while. Wonder what that RS number is. Oh, it's come off.
Mhm.
We
Mhm.
would have to find something a little bit closer to its top. But if you would have looked at that back in April when it
Yeah.
was well off its high, it was probably still a 99 or a 98 back then.
Anecdotally, what first told me, about this slowness, especially as a sell signal, is Qualcomm. Back when it topped in 2000, of course, it had had a 2000% gain in a year. And when it was off 40% from its high, which you would think, oh, if you're going to be off 40% from your high, that's going to do some damage. Well, for Qualcomm, that still meant it was up 1,000%, or more. So it was still a very high relative strength. So again, being off 40% didn't even knock that relative strength down very much, that number. But you could certainly see in the chart that the relative strength line was getting into some trouble.
Yeah.
Okay.
And that's why I was just going to say people should use as part of their what they look at the 3 month RS because I developed that for that problem. So
Right.
you can screen off of it. You can see it on the related panel on the right, and you can see the 3 and the 6 month. Develop both of those, but I prefer the 3 month. It's a little bit a better contrast versus the 12 month.
Mhm.
There's a time and place for both of those.
And I think looking at this technical action, it gives you a good picture. Okay, if you've got a stronger relative strength rating and a weaker 3 month, that kind of tells you, oh, this has been recently weaker, and that's going to be something that doesn't excite me as much. However, if it's the opposite and the relative strength rating is a little bit low, but the 3 month is on the higher side, that kind of tells me, oh, this is something that's maybe turning around and maybe worth a little bit more attention on my part. Something that might not have made the relative strength rating screens that I have, because a lot of times I put those at 80 or higher. But if I do a screen of the 3 month at 80 or higher, it can get me some new ideas that are maybe a little bit wouldn't be on my radar otherwise.
Exactly. And one last thing on this, and we can move on. That 4 weeks ago, it was still the normal RS
91.
91, which I think was the original point. So
Yes.
yeah,
So just looking at that 4 weeks ago, and probably what happened is, again, we're starting to get, some of the year ago stuff, some of the quarter ago stuff, and so on, dropping off. But yeah, if you think of how ugly this looked 4 weeks ago, and this was showing a 91 relative strength, oh, that just kind of makes your point exactly as you said, Mike. Let's take a look at consumer discretionary XLY. This hasn't been too bad. It's been getting support at the 50-day moving average line, Friday being an exception, but it kind of bounced right back, although we are still inside that ugly Friday.
yeah, but it looks, that RS line looks good. And what I like about this versus the XLRE that we were looking at is this one hasn't broken out yet. You can see the cup with handle. I know Pattern Rec's showing it as a flat base, but it's really a cup with handle. And so it hasn't broken out yet. It tried to break out and then pulled back in as the market was coming in. So this is an area where I would look for names. And you and I were talking about Home Depot and Lowe's before the show that are in this group. And those are both, they've got, kind of lower RS ratings as well as the line, but they're not horrible, but they look set up. And these are some of the things that we were looking at for SwingTrader. We could have put this on today. In fact, technically, we could have put it on Home Depot on late in the day yesterday as kind of a setup day and added to it today. But we sat on our hands just because of the uncertainty of the market as well as, just getting through tonight. Hopefully it's a non-event and it doesn't move the market around a lot, but we just didn't want to, after last week's hit that we took, we just didn't want to add to that. And we wanted to, just get through a little bit more time before we added. But I think this is a space that you can look at. The home builders in general are looking good, and is one of the areas that it has held up.
Mm-hmm. XLU, one of the surprising darlings of this market. Again, relative strength has been doing very well lately, and I mean, this has been trending above the 21-day moving average line, and it's kind of like what pullback?
Exactly. And like one of the ones we were looking at to maybe add yesterday was NEE in that space. Could add nice upside reversal at the 21 day. And again, we just passed on it, just opting to just hold on to that cash for safety. But it's nice to see where things are setting up and where they are working, and utilities are, you never really want to be trading REITs and utilities, but you trade what you can trade,
Right.
and
Yeah.
that's the market you have.
And I do have a position in this myself. This is in my my 401k account, so it's a little bit. I don't touch these as much, and I don't trade them as often. But I've had this one in there for a little while when utilities were starting to really outperform. Going on down again. This is based on the action of today's in order of strongest to weakest. XLV. It kind of had a few ugly days here, but this is one healthcare right there at its 21-day moving average line.
Yeah, and a big component here is UNH. I was looking at that earlier today. I just didn't get a chance to see what the news was that drove it down yesterday, and so we didn't do anything with it because I just didn't. It wasn't good enough to add without knowing really what happened there. But it's right around the $600 figure, and I think this looks like a good place to uh, good pond to fish in, the XLV stocks. And I think this is, one that's on the safer side of things, as safe as any stock can get.
Mm-hmm. Another one that's kind of been on our radar,
Mhm.
DVA. This is another one that I actually got along with Leaderboard and have kept the position in that 401k account.
Yeah, it looks great.
XLI. We haven't talked too much about industrials. Not as strong, but still above the 50-day.
Yeah, I mean it's worth playing through some of the names in that sector. Can't think of any off the top of my head right now that I was looking at.
Mm-hmm. XLB, the materials, a little bit sharper of a pullback, a little bit weaker on the relative strength side, but still above the 50-day moving average line, and kind of made a stand here today.
Yeah, major expectation breaker on that one, right? Because it looked so good that past Friday when it was poking up there. So I would be a little bit careful with it just because, uh, you know, you finally have a couple. Well, yesterday was up and then today was essentially flat. I would just give this one a little bit more time just because that RS line is just problematic.
Mm-hmm. XLC, of course, Meta and Google are two of the heavyweights in here. But I mean, we were talking about things like AT&T, Verizon. I mean, these are looking very strong. So XLC, if I can type it, XLC, weak and below the 50-day moving average line. But there's some stocks that look interesting.
Yeah, so that's why you don't want to completely throw out things when you look at the industry and that it's weak. As long as you understand that it is really this group, because it's the market cap weighting is so heavy with the Google, and Google looks so bad, and Meta was looking good and then it didn't. That yeah, like the Verizon. Go back to the Verizon on a weekly, because I don't think I've ever traded Verizon in my life, and that looks set up like it's a nice long base, like it wants to, imagine we're looking at the same chart 3 months from now and it's up at 55 or maybe even higher than that. And we go, God, where were we at this point? I mean, it's in position. It's just who wants to trade Verizon and AT&T? But then again, who wants to trade REITs? And they're doing well.
That's yeah, that's where it is. You know what it reminds me of a little bit is back in 2016 when I first started writing for the paper. And I would say that this was probably in January. This time frame right here. But yeah, when I first started, Verizon and AT&T were kind of top of the IBD 50. It was it was uh, pretty interesting. I was a little surprised, and I mean, you had some utilities there as well. The utilities again at the beginning of 2016 So again, a lot of times you will see the IBD 50 start rotating to some of these areas, and you're like, wait, what? Why is the IBD 50? These aren't growth names, but the relative strength is important, and things that are not performing well will just get lower and lower scores. So
Yeah, you know what? That made me think of back in the day when we were trading the fertilizer stocks back in
right.
'06 and '07. Pull up CF and do a change date to October 27th, '06.
Oh,
Um,
six. Okay.
yeah, October 27th.
Yeah.
And if you looked at this, you would probably be saying the same thing. Who wants to trade fertilizer stock? Let's go to the weekly on this. And as I was saying that out loud, I'm thinking, God, that sounds like what we said at the beginning of what potash is not traded anymore. And I think there was an IPI or something, but CF was the classic model book stock. And, it had formed two bases, hadn't really gone anywhere. This is this weird group, but just go out a year, go out to '07. And that was one of the biggest stocks during that time frame. So it's a reminder to you guys as well as us, to keep an open mind with these stocks that you normally wouldn't want to trade, but they can have these big moves. You don't always have to be trading the Nvidias of the world, that you can trade these other ones when that's what the market wants. So sorry to get derailed again, but
it's so easy, isn't it? So we talked about XLC, and speaking of the defensive side, I mean, XLP, this is the staples. And I mean, for a while there, I mean, we were looking at things like, Coca-Cola. I mean, look at the uptrend there. Now, keep in mind, you gotta look at the weekly chart to put it in the perspective of, this is not something that typically moves. It's been moving pretty strong lately. You've got some of the I accidentally when we were talking about AT&T earlier in our pre-show huddle, I accidentally typed Tootsie Roll instead of T for AT&T, and I was like, what the heck is going on with Tootsie Roll? I mean, I can't think of the last time I looked at this one. But you also brought up that some things like Campbell's Soup seemed like they were looking a little ugly today. So back to XLP. Overall, what's your thoughts?
Well, the other one that we were looking at with the Coke, the KO version, was the COKE version of Coke, and how that got hit. And it was kind of like, this perfect stair step pattern. I know Chris Gessel isn't a fan of stair steps, but from a swing trading standpoint, they are nice if you can catch them right while the chart is still intact. But with this one, it built this little shelf up here, or a little stair step, and now it's broken down from there and changed its character. And I was noticing that with a lot of these slow pokey XLP type of stocks today, it was kind of a mixed bag. Some of them were holding up, but some of them were having abnormal breaks to the downside. Now I don't know if I don't know why. I didn't get in meetings all day. I didn't get a chance to read the news, but you look at the chart and just go, that's a warning sign, because it's something unusual.
And even though the day doesn't look that bad, keep in mind, this is a day where the NASDAQ was up, 0.8%, the Q's up 0.9%, and the S&P 500 up 0.5%, and this is down. So the third worst group. Financials, another actually pretty poor group. This is one that had been looking very strong, but a little bit of a hit. We had Goldman Sachs on, previously, and that one was very, very quick to go as that, started defying our expectations. JP Morgan didn't look too bad. Yesterday, kind of an inside day, so not something we wanted to act on, but looked like it was getting support at the 50-day moving average line, and then a real ugly day. KRE, the regional banks, that did seem to get some support at the 50-day moving average line. KBE also, support the 50-day moving average line. So any thoughts on XLF in general?
Well, yeah, it's an area that I would stay away from because of today's action. When you've got the Goldman Sachs, which is really kind of the cream of the crop in that space getting hit that bad. You just need to give it time for people to digest, why did it move like that? A 4% move for Goldman, that's a big move on the downside, and more importantly, breaking through that 50-day in the way that it did. This is a stay away from those names for some time. But we were looking at Blackstone BX, which is in the same general financial space, and that one looks completely different, kind of like what we were talking about with the XLP, where you had the one version of Coke looking good and the other one looking terrible. And this one looks set up and is something that we were, contemplating adding to the list today. Again, we just sat on our hands and didn't take any action because sometimes your best thing to do is just wait. But that was, that was in position, and that was a classic entry that you could have done from a swing trading standpoint or a more orthodox kind of the way leaderboard approaches things standpoint. And so you don't want to throw out everything in that group, but I would stay away from the JPs and the Goldmans and the Morgans for now.
Yeah. And the worst performing sector spider ETF, that dubious honor goes to XLE, the energy sector. Very heavily weighted in ExxonMobil and Chevron, but this just doesn't look as great. I mean, that's a downtrending relative strength line.
Yeah, downtrend in the price, downtrend. Just stay away from it. But let's go to the monthly on this one. Why you want to keep an open mind is there's pockets in there where it does outperform. Not very often, but you do see that time where that RS line was just smoking higher. Not that a couple of years back. So you want to be open to it. Bill was always kind of close to oil stocks. I mean, he traded them in the 60s and 70s, but
you know what? There was a period in was it 05? I remember he was in Valero.
And there was a little period, but it was short-lived, because he just didn't like them because they tended to. We'll just pull up like Exxon, it's kind of the poster child for let's go to a daily on it. Where they set up it to break out and then they just break down, or they break out for a little bit and then they base build again. It's a very hard group to buy with our style. You would really have to be more of a bottom buyer to make money in that space. Just not something we do well.
Yeah, it's definitely one of those. If you were using like something like earnings, then by the time the earnings are looking strong, it's too late. The move is done. You kind of have to get it when the earnings are poor.
Yep.
Looking at that earnings line, it's by the time the earnings are strong, it's done.
Yeah, I remember Bill explaining that to me, because I hadn't really thought of the cyclicals in that way, and you've got to flip everything upside down on that and buy them when the PEs are the opposite of what you would think, and where the earnings line, it's just a whole different game, and we frankly just don't do a very good job at it.
So just to kind of wrap things up, a few other things that we just wanted to kind of mention. One of the things going forward, look, there's a lot of changes that can happen, in the next week or two, or, even more. Seasonality, something that you mentioned, Mike, that you don't give too much weight to, because look, you can say, oh, September's a typically weak month, but then there's some Septembers that are phenomenal. 2007, I think, was one of your best months probably ever. And September 2010 was a great time as well. So you can't just say, oh, they're all bad. So a couple things to kind of help folks out. If you are an IBD Live member, this is a show that we do every market day, I should say, that the market's open.
We don't start on Saturdays anymore.
No Saturdays. Don't get everyone ideas. So we start 10 minutes before the market open. So that's going to be 6:20 Pacific time, 9:20 Eastern, and then we go for a full 100 minutes or more, depending on who's hosting. And one of the things that is a feature of this is that we have two lists that we kind of go over. that we offer to subscribers. One is our IBD Live Ready list, and the other is our IBD Live Watch list. And these are basically curated by Mike. I mean, every now and then I have to dust off my routine to take over when he's on a cruise. But yeah, Mike is curating these, and a great idea to do is if you kind of go through some of these IBD Live watch lists, if you just sort by price percent change on any given day, a lot of times you can just go through these pretty quickly. I'm going to hit the space bar and go through some of these. Oracle, phenomenal move on its earnings. Boot Barn, I think they did sales announcement today. Impinj, this is something we talked about on IBD Live yesterday. One of the few semiconductors looking okay. But yeah, you can get a lot of good ideas. EQIX, I mentioned on IBD Live today. Zillow Group, this is
That looks good.
Yeah, that looks really good. I do have a position in Zillow myself. But yeah, you just kind of go through these, and it really kind of gives you a sense of some of the stocks that are acting very well. And then, of course, for our SwingTrader subscribers, while we are sitting on our hands right now, looking at some of these from the sidelines, when we do kind of get that confidence that it's time to act, that's where you do get those alerts throughout the day. And you don't have to wait until Tuesday after the close to kind of get our sense of where we're at and what we're doing. You kind of get that real time as the day progresses. Any closing thoughts for you, Mike?
No, I just think people should really use those lists. Take a trial for IBD Live if you're not subscribed already. Use those lists. Those are my personal watch lists. At first I was keeping a separate one that I would share with everyone, and then one for myself. But I decided, you know what, I'm just going to share my personal watch list and my ready list every day with all those subscribers. So hopefully it helps. And those are the ones where we pick stocks from SwingTrader for. So if you're wanting to know what we're looking for, we tend to only focus on ones that are more liquid. So you can look at those lists and just get rid of the things that trade less than $75 million volume. And those are the ones that that's the pond that we're fishing in. And it's not screens. Those are handpicked. So I would utilize those. Hopefully those will end up helping you. And join us every morning. It's a lot of fun. We don't babble on very often.
So you get four of us babbling on instead of just two. So that's but I mean, we had David Ryan on today. He's a weekly guest, and we have some really interesting guests. A lot of Fridays we'll have different takes from folks. David Keller, Jim Ropel, Mark Minervini,
Joe Fahmy.
Yeah, Joe Fahmy, he's a regular. So yeah, we get some outside folks giving their takes on the market.
And you have Matt, who you just did the
Matt Russo. We just had the podcast. And as a reminder, tomorrow Harold Moore is going to be on the podcast. And just like what we do today, where we go live, it's still available afterwards, but we do this live. Our podcast has changed to going live. So tomorrow after the close, basically half an hour after the close, roughly an hour after the close is where we're going to start that up, kind of the same time as SwingTrader here. We're going to start that up at Wednesdays live. And so you'll be able to watch some of these guests, kind of go a little bit deeper into their philosophies and their takes on the market and stocks that they're watching. So hope you join us for that.
Live, or is there a 5-second delay?
There's probably a 5-second delay, but but not enough time for us to censor anyone, if that's what you're worried about.
Yeah, just wondering.
Very good. Okay, well, hey, thanks a lot for joining us this week. We will catch you all next week. Take care.